The Hedgeless Horseman here again, January the 2nd, 2022. I just wanted to do a follow-up video on the last video, using another example to show what I mean about value trading and risk reward, etc. And I think it might be better to, again, use another example, so maybe it's easier to understand the concept, because you might not know magna mining, for example. But let's just look at Lion 1, for example. A very volatile stock, like most, and we know that, okay, compare, let's bring in our junior mining sentiment proxy. Yep, it topped here, Lion 1 topped here, then it went down and pretty much bottom the exact day that Bear Creek Mining bottom. And again, people will talk about how this market is so rational and how it's so hard to beat, etc. So if that's true, it means that pretty much Bear Creek Mining and Line 1 had very similar fundamentals. And value went down considerably, starting on almost the exact same day and ending on the exact same day. Suddenly, the Line 1 wasn't getting any worse, and Bear Creek Mining wasn't getting any worse, if you believe that price is always right and the Mr. Market is right. But then I don't see, again, how you could possibly explain how these shorts pretty much, well, at least the major trends are almost exactly identical. No, the obvious conclusion is that this market is a total sheep. I mean, it's a flock of sheep, if that's what's it even called. I hope you understand my point here. It's like, no, Bear Creek Mining and Line 1 metals do not share many similarities at all. They are not even primarily in the same metals. Yet they pretty much top and bottom on the exact same day. So basically we can conclude that on at least short-term, medium, at least a short to medium-term basis, given the sentiment swings in this sector, for whatever reason, there are long periods where everybody wants to sell, regardless of what the fundamentals do, and periods where everybody wants to buy, regardless of what the fundamentals do. So again, it's like, give up the idea that the market is always right, and oh, my stock is up or down today, what happened? Nothing, probably nothing at all happened. This is just people voting with their feet. And again, it's like, on a day-to-day basis, 95% of buys and sells will be made by people who do not beat an index. If you're buying from someone who's obviously selling, there's a 95% that the ones selling to you don't beat an index. And it's typically you as a buyer, probably don't beat an index either. So it's basically on any given day, on any given trade, there's just people making bad decisions to bad decisions. And of course, I mean, buying and selling is all a matter of perspective, and buying, what was I gonna say, of a time preference, because anyone who bought here is buying from someone who's selling. And just a few days later, it looks like the one who sold was correct. And the one who bought is sitting in a paper loss. So one would, if you just look at the results, short-term results, one would say, this person who sold here is, made a good call. But fast forward a week or whatever later, that sell became a bad sell. And then back to a good sell a few months later, because price went down even more. This is all chaos. This is all chaos. These juniors can swing, as you see. They track each other. regardless of what actually happens with the companies, because the sentiment is that strong. It is such a big driver, and that's obviously why you have to keep sentiment in mind, because the really big swings on a medium-term basis are sentiment. But sentiment alone is not going to have or typically will not have a mature, no-growth company become a 10-bagger over 4 years. Because they don't create any value. It's typically gonna trade like Bear Creek Mining, going up and down, up and down, up and down. So it's just, yeah, if you get in here, for example, in Bear Creek Mining, you can actually have a 5-bagger. Same from this level, you maybe have a 5-bagger without much having changed for the company at all. But typically you won't get a 10-bagger unless you buy the exact bottom and hold it to a decade high sentiment top or whatever. Now it's the growth alpha plays that can become 10-baggers typically if you hold them over, let's say 2, 3, 4 years or whatever. But in the meantime, and during that time, I mean, in this case, for example, line 1 has pretty much been growing throughout this whole time period, and still you have huge swings. This was the Corona flash crash. Nothing changed at all for Bear Creek, for line 1. Still, price went down 67%. 2/3 of the market cap wiped out in like a month. Obviously, totally ridiculous. Totally ridiculous. Nothing changed for value in a 1 month period. Yeah, people just wanted to sell. So it's like, you can't say that this market is that hard to beat over at least I would say 4-year period. If you understand just how much more price swings than fundamentals on a short-term basis at least. Because yes, if you bought line 1 here and we entered a 2-year bear market in juniors, it's going to be very hard to look smart and have a profit. But fast forward 2 years after, let's say, the juniors have bottomed and probably are going on a 2-year uptrend, then I would say you're probably, I mean, let's put it like this. Yes, we have a 2-year bear market. For you saw it in Bear Creek Mining, so almost everything goes down. Nothing to do with the case, let's say, the fundamentals. The gold didn't go anywhere, yada yada yada. A lot of stuff can happen over 2 years, obviously, but let's say the case is somewhat intact, or maybe even better. 2 years forward, I would say that there's a higher likelihood of line 1 being above this level, for example. And obviously the change in between, we're talking about a 4-year span from here to here. And sure, yes, if we just go back to this, that means a buy at this point in time will only break even and you would need more. Yeah, but it's like in the meantime you had, what would that be, like 3 years where you could buy it below fair value. So you have no business not being in a profit, let's say, when some of these stories actually, again, keep on doing what they have done. Let's say, grow and create value. But of course there will be dilution, etc. in the meantime, but it's like a 4-year swing like this, 2 years of a bear market. No bear market lasts forever, so you knew that every additional day that these juniors went down brings them one closer to the ultimate bottom, the lowest price you're going to pay in years forward, and which will make a quicker and higher future returns. I've gone over this a bunch of times. It's like you don't even need to know when the bottom is in. You just need that, hey, if it's already very cheap, every additional day it gets cheaper for no other reason than, scared money, weak hands selling out. That means that that's one day closer to the ultimate, bottom, the hopefully multi-year bottom. And obviously, if this is was the bottom, even if you bought at this point and this point, this is a bit closer to the actual bottom, if it's not the bottom, simply because it's gone a month extra, let's say. And since some time has passed, the pace of future expected returns are going up because you're closer to the uptrend by definition. If this wasn't the bottom and we reach this level here, because either this isn't the bottom or it is the bottom. If it's not the bottom, maybe a line one would have gone down here and then started an uptrend. So that will still be closer to you being in a profit than here. So again, buying becomes exponentially better. But let's get back to the point. Like I write here, price tends to swing a lot more than long-term value. Okay. Let's say you have a 5% position here in line 1. It goes down 62%. Okay, what happened here? Well, we know, it went up on great results. They haven't gone anywhere. Okay, it went up for whatever reason. Mr. Market said that this is the fair value for line 1. Fast forward, what's that, like 3 months? Apparently, fair value for line 1 was 62% lower according to Mr. Market. Who can come up with this stuff? Obviously, that's total nonsense. That long-term value would swing like that. But what actually happened? Okay, you have people kind of front running a race. Then the race happened, which was lower than I had hoped, and then we had panic selling, basically people throwing in the towel and say, okay, yeah, do you think those people will ever beat the market? Why do you think they're selling? It's like, who cares? Let's say on this news, let's just say this is the growth trend, whatever, and let's pretend that before the news value was up here at this level, then after the news the implied value of line 1 went up there, so you have a 37% expected return going forward without anything else changing and not creating any more value, really. Okay, that's a big jump of course in price, but fundamentals also increase, so that's understandable that it goes up. But that doesn't happen to every company, even though they add a lot of value, and that's why you can beat this sector anyway over a 4-year period, let's say. So here you have a gap like this, and then you have front running, people selling, shorting because some know that they're gonna buy in back later or whatever. So let's say the dilution comes, and it's like, dilution is like a bad carrot that's dangling in front of the market. So no price is too low to sell because you think that it's gonna go down when financing happens, because everybody knows that dilution is so bad, etc. Meanwhile, if everybody expects really good results, no price is too high because everybody expects that at whatever price the shares will be trading at, when this positive news hits, it's gonna go up because it's positive news. And that's how people lose their asses all the time, because everybody is already in when the actual news come, and then there's just selling left. And kind of like here, it's like but actually here, when news hit, it was at a lower level than thought, and it crashed way beyond that. But let's say, okay, nothing other than a change in capital structure, let's say, happened, dilution. So let's say after this news, let's say the fair value for line 1 was up here, and here you had a 37.7 price to fair value gap. That's pretty good. It's like, if you could average, if that takes, well, actually even 2 years to close, that would be pretty good. But maybe not the highest one could hope for. But at this point in time, just a few months later, line 1 is down here. So even if you take away, include the dilution, I don't remember exactly what percentage of dilution is, was, but let's say, you know, the fair value that after dilution went down here. So now value per share went from here to here, fair value, okay. But price is all the way down here at this point. So even with dilution, and we, you know, take fair value a bit lower per share because there's more shares out. Obviously, this would be a much better opportunity than from here to fair value before it was diluted. Simply because price was so much higher, and now price is so much lower, 62% lower. I would say that the risk reward here is a lot better than up here. And any value trader or value investor should look at it like that. Most, of course, just, I mean, they rather buy. I mean, I added after the news, for example, in here in line 1 because I thought the news was so good. That doesn't stop the market from doing a total reversal when it peaked and went down 62%. But let's be, you know, a bit rational about it. Okay, if let's say you were happy with a 5% position here. Down here at this price, when the risk reward is much, much better, what position size should one have? How good is this case all of a sudden thanks to the volatility in the market, thanks to people selling off the stock? I would say again, it's a lot better. So one should have taken a bigger position here than one had up here. So again, assuming the case is correct, it continues to grow, etc., we won't be in a bear market forever. So, I mean, let's say, again, in 2 years forward, we'll be up here in line 1, for example. Okay, if we didn't have this charade down here, and let's say just value kept on going up, so in 2 years we would have, let's say, an expected return of 61% from this point, if shares just kept on going higher. That's what everybody dreams about. A never-ending climb. No flash selling, no panic selling, no bear markets, etc. Okay, your 5% position would turn out to be, you know, what's that, like 8% or whatever. Okay, your $1,000 invested here would turn out to $1,600. Yeah, okay, but now this happened. And of course, 95% of people will always see any decline in price in any stock they own is as a total curse. But let's say this is intact and we will get there, or maybe slightly lower with dilution. Okay, let's be fair. Let's draw it down to this level here with dilution. Okay, but from this level here, that's 300% expected return, assuming the value creation just continues. All else equal. So the question is then, are these big declines, flash crashes, bear markets, are they a blessing or a curse? I would say it totally depends on how you look at investing. Because yes, your current position, your holding took a big hit, but from doing so, an opportunity much better than up here was created. So maybe you sell stock, I don't know, X, to keep it simple. Because you realize that, hey, I'm down on line 1. I'm not so much down on stock X. And I even liked stock X better than line 1 up here. Maybe you had a 10% position in stock X. But that didn't get hit by, you know, people front running in placement, and then the placement and panic selling, yada, 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 bear market bottom. So maybe stock X all of a sudden down here, when you have this opportunity to buy line 1 here at this price, maybe you should not have 10% in stock X, maybe you should have 7% in stock X and 15% in line 1, for example. Again, if the case is intact and when we get back to a more fair market, and there's no guarantee, value creation will continue and will for sure gonna hit, let's say this level in 2 years. Who knows what might have happened? But knowing the future is not what it's about. It's about risk reward. So again, I would say most people look at this as, let's be honest, how do people invest? Most people buy here, then they sell out here because of the poor performance, the past poor performance. And they say, well, you can't make money in juniors, this stock is crap, yada, yada, yada. Meanwhile, being totally oblivious to the fact that every stock has gone down for over 2 years. Like you saw in Bear Creek Mining. And what will happen in this sector, at some point in time, everything will be up. But people take it very personally. They think that this stock has all of a sudden gone to crap because Mr. Market is selling shares, the marginal investor. And they sell out here because they started with a 5% position. Their hopes and requirement to even own the stock is that it will just continue to go up forever. The ones who are not, let's say, first level thinkers, they realize, hey, okay, this sector was, or Mr. Market was already whacked with line 1. Now it's just atrociously out of its mind. And again, you take, let's say, a 15% position up here. And if that 15% would remain a 15% position, it goes up 300%, you would have made a lot more money in line 1, thanks to it having crashed, relative to if it just kept on going higher. And as its price went higher, the risk reward decreased, and you should really be selling, even though it's like, if you did nothing, yes, you'll get your, I don't know what it was, like let's say 48%, 50% return. That's great, and all you would have, 1,000 would turn into 1,500. Down here, if you invested and put it up, all else equal, you had $3,000 invested, it would go up 300%. So that's, $12,000 all of a sudden. So you'd make a lot more money simply because you didn't predict Mr. Market. You didn't know this flush was going to come, but you took advantage of the volatility when it came. Volatility is, both volatility down, opportunity to buy. Let's say volatility up, opportunity to sell. And again, it's like, okay, if you thought at this price here, this risk reward is so good that I'm comfortable having a 15% position, what should you automatically do as price goes up and risk reward goes down? Because down here you had an expected return of 300%, and let's say it was the third best opportunity you knew about or whatever, and you had a big position. Up here the expected return is 147%, so that's almost half of the expected future returns are already gone. You banked them. You've had short-term paper profits, which means that there's less future paper profits left, all else equal. So the natural thing to do, if you just held, you would be up to a 22.5% position, around that. If you bought, so you had a 15% position down here. In reality, what should be done is like, here is where you should have higher exposure because risk reward was better than up here. So if you did nothing, you would be sitting in a 22.5% position in line 1. Maybe you should in reality be down to 12%, simply due to natural evolution of the risk reward. Price increases with, let's say, value has not increased. I'm just assuming here that, no news has been out and we're just, the price is all that's changed really. You should have a lower exposure because you already had some returns and there's less in store in the future. Same here. What tends to happen is, of course, that as price goes up, people get more bullish and they buy in even more. So maybe they started with a, I don't know, 5% position here. Let's say not much changed except price going, expo for a while. And if you had sold nothing, maybe you would be up to, okay, it's actually not that. Well, let's say from here or something. So if you had a 5% position here, and let's say not much had changed, and you held on, so you would have a 10% position here. What has happened, assuming there was no news out here? You would have, price would have gone up, you would have returns, let's say 100% return. That means there's less expected upside in the future. So you shouldn't have 10% position, just, robotically sitting put with your 5% position that went to 10. I mean, in reality, maybe you should be down to 3% position or whatever. I mean, it might be, still a very good case. And if we go down to this level again, which happened, maybe you should go up to, like here, 5% position. And here you might, here maybe the risk reward is getting better. So here you should have a 6% position, 7% position, 8, 9, 15% position. And then as it revalues higher, you would have the best or most exposure when the risk reward was highest. But then, of course, you would naturally decrease exposure as you were harvesting some of the risk reward. Price went up, okay. You don't know when, you just know that this is cheap, probably gonna make some money on this, okay, price revalues. So again, in reality, if nothing really has changed with value, it makes no sense to, if you have a 15% position here, you shouldn't just let it ride so you have even bigger exposure here, because obviously down here it's a better buy than up here. So I mean, that's basically what I call value trading, and why buys and sells kind of take care of themselves. Because let's say again, line 1 revalues down here was, let's say a top 3 buy, but you have another stock that instead of let's say it didn't crash, it went something like this, and then for whatever reason it crashed like line 1. So this is the new price of stock X, this is the new price of stock of line 1. All of a sudden, okay, you had this little revaluation, and maybe you should be down to a 12% position. But in stock X, maybe here, it wasn't the absolutely best case. Maybe you should have 6% exposure at this point in time when price was here. But let's say, again, it's just from volatility, someone's selling, it's down here. So maybe instead of 6% at this price, when it goes down to this price, maybe you should have 9%. In that case, you could obviously, I mean, if you just had these two stocks, as the risk reward and expected future returns goes down in line 1 as price increases, risk reward goes up and expected future returns goes up in company X. So then you could, instead of having, again, 22.5% in line 1, you could sell some of that, reduce exposure down to, let's say, 12%, reflecting the decreased risk reward as price went higher, and put that in the one that went down for no reason, where which should now, at this new price, provides an even better opportunity than just, a month ago or so. So I mean, that's kind of how I would sum up, value trading. I don't try to predict this. It's like I didn't know we were gonna have a flash crash, but when it happens, like beyond the obvious, nothing really changed fundamentally for a lot of these companies, but you all of a sudden got up to a 60% discount. I mean, that's an absurd buying opportunity. So let's say you like two companies equally much. One went down, I don't know, 40%. And another one went down 60%. Of course, there's a better opportunity presented by Mr. Market. Not that you foresaw or predicted that. It just you just react to the volatility that's happened. What the prices are given to you by Mr. Market. Then you could obviously sell some of the stock that went down 40%, and you wouldn't be too bothered by it because, hey, okay, I take a 40% loss in this, but a 40% loss, and I getting even cheaper in a better story. And in this case, line 1 went up 268%. So maybe that other stock you sold would have revalued higher as well and given you 100%. But you took a 40%, let's say, permanent loss because you actually sold, which had an expected return of 100% within a few months. Shouldn't say expected return, but you know what I mean. And you bought this instead. So it's okay to sell at a minus 40% loss if what you're buying is, going up 270% instead of 100%. Obviously, that's like 170% extra risk-adjusted free money by Mr. Market. So again, it's like when you start to understand what volatility is, it's going to be very hard, or especially in light of risk reward. If you're all about price and value, risk reward, understanding that the sector can go down 2 years straight and then up 2 years straight, etc., nothing really to do with the fundamentals of any company. That's just how this sector works. That everything goes down for years, then everything can go up. I mean, typically the rallies are even shorter in time than the downtrend. So maybe you have the 2016 rally was like 8 months from the bottom. Some juniors, including Bear Creek, went up like 600%, just 8 months. So it's like the market sucked for many years, then all of a sudden after the bottom it went up 600% in a much shorter time frame. So if you understand risk reward and assume that the market is pretty much batshit crazy at any given time, especially at sentiment extremes, like extremely low sentiment, everything is typically extremely cheap, you should understand that, like, as price decreases from already low levels, the future expected returns go absolutely bananas. So volatility, short-term volatility at extremely low levels open up huge opportunities for your future portfolio performance if you can see what an opportunity is. So again, it's like, hey, does it suck when, let's say, a stock crashes for, I wouldn't say no good reason, but like, let's say there is negative news, but the reaction is way over exaggerated. That's all of a sudden an opportunity. Because if you had, again, like a 5% position even in a stock, it goes down 60%. Yes, that sucks, short term. Right now, when it happens, yes, your 5 position, oh, geez, my 5% position is down 60%. Sure. But maybe the opportunity created, that was created by this total washout in that stock, was so good that, hey, I had 5% exposure before. Now it's down to less than 2.5, but I should actually add, hundreds of percent extra exposure. I should go up to 10% of my portfolio in this stock after this flush. If you're, somewhat correct on that, you're gonna make even more money than if the flush didn't happen, probably. Or I mean, it can be like that because, like I showed, let's say before a crash, you know, expected return might be 56. That's not bad, but all of a sudden if you get 260, that's years worth of returns. So again, if let's say all of your stocks have an expected return of 40% over the next 2 years, and you have one stock that absolutely gets slaughtered for whatever reason, I mean, that suddenly became the most no-brainer buy of your entire portfolio. So if you had 5% position in each of those 20 stocks that had before one crash had a 40% expected return across the board, you know, again, across 20 companies, and now one of those 20 have an expected return of 263. Obviously, you should have more than 5% all of a sudden. Let's say you go up to 15. You sell some of the other ones that has an expected return of just 40, buy some of the, you know, add exposure in the ones that's going to go up or has an expected return of like 270. You're going to make more money because the crash actually happened than if everything just was smooth sailing and they all went up 40%. So the irony of this sector and investing overall is it's volatility that people can't stand. It's volatility that kills people because they actually believe the bullshit that Mr. Market is selling. While, again, ironically, it's thanks to volatility that, I mean, that's the only way you can have really good returns. If this market was totally efficient and just went like this, everybody would have the same returns. But when you have a market or a sector that can go down 50%, up 300%, down 80%, up 600%, how much obvious do you need it to be that volatility is actually, that's the thing you have to learn to take advantage of and use. Otherwise, you'll never, well, first of all, you're not going to beat an index, but you're going to do like most people. They sell when they should obviously be buying. They not only should they be buying, maybe they should triple their position. While again, most people, let's say they start with 5%, they get cut in half. Think, oh, you know, Jesus, I can't make money on any juniors. I never make money on juniors. Totally regarding the fact that everything is in a bear market. So it's like, yeah, that's just how this sector is. And totally oblivious to the fact that, hey, I mean, yeah, maybe it was a real, even better opportunity here already, and now it's just a no-brainer opportunity, let's say. And instead, they just, you know, go from 5 to, let's say, 2.5% position, then they sell out. And then they, you know, scratch their heads. How can't I beat this market? Then they come back like 1-2 years later, and all of a sudden the thing that was trading down here when they sold out, it's back up here because the sector is in a bull market all of a sudden. But they don't. I mean, again, everybody's focused on the past, what has happened, or the immediate future, guessing where the stock is going to go tomorrow. First of all, they're colored by this. And then they try to predict what's going to happen tomorrow. So if it's in a quote downtrend, they always predict that price is going to go lower. And when we're in uptrend, they always think that price is going to go higher. And no concept at all about what is this stuff actually worth. Because they assume Mr. Market is always right. But again, it's like this sector, it's how this sector is. 2-year period where everybody wants to sell. And you see these swings in sentiment. Should be, I mean, this is Bear Creek, it's lower than it was 2015-16. Again, you can see, I mean, the pattern back here already. Bear Creek and Line 1 pretty much topped on the same day. So if the market is right, does that mean that the value of the fundamentals of both companies topped on the same day, then went down for like 2-3 years? Of course not. So it's like you have to stop taking this market seriously. You just know that for whatever reason everybody wants to sell low, and for whatever reason everybody wants to buy when it's high. And then just use common sense. And again, that's risk reward and price to value, etc. If all else equal, if price goes up and value does not, the opportunity decreases. All else equal, price goes down, value does not go down, opportunity increases. So one shouldn't really have more exposure on the way up. I mean, if you just let it ride, by definition you will have more exposure, assuming that not every other company does even better. But in reality, as price is going up, the opportunity is going down. And as price is going down, the opportunity is going up. And that doesn't mean, it's like, some people, oh, you were bullish on this stock and sold. Let's say, I mean, again, if you buy here, line 1, for example, and you're bullish, maybe you take a 10% position. Up here, you take 50% off the table, assuming price didn't go up. Here, actually, value didn't go up a lot as well. Here, actually, I think value went up a lot. So this wasn't as clear as, just a spike for no reason. But it's like, are you bearish, let's say, a stock if you go from a very big position to a lower position because price went up? No, you're just rational. So but the thing is that again, what typically happens, I mean, in growth cases, I think you can actually hodl. I mean, if your average in line 1 is, I don't know, here, like 1.3, I don't think that's going to be a problem in 2 years. I think you're going to be in profit. I think if you only go up, let's say, to this, that's 68%. I mean, that's more, if you get 68% in, let's say, well, let's say 3 years, I mean, it's not superb, but it's certainly not bad, even though everybody will think it's bad because everybody's chasing 10 baggers tomorrow or yesterday. But again, it's just buying and selling kind of becomes natural. And that's actually one reason I like being fully invested, because if I'm gonna buy something, I have to sell something else. So it's like, okay, line 1 goes down here. You add. Why? Because risk reward was so much. All of a sudden got really good, much better than it was, let's say, here. Okay. So even if you were bullish here, you're extremely bullish there. Okay, but what do you have to sell? You can sell a stock that has not crashed like this. The least favorite buy of all your holdings already, you could sell to buy one that has gone from top 10 to top 5 all of a sudden, perhaps. Just thanks to volatility, just reacting to it. Yeah, I mean, that's pretty much, that's how I guess I would sum up what I do. And I because if you keep in mind at all times price to value gap, etc., and risk reward, volatility is like typically more of a blessing than a curse. There's 2 scenarios where volatility is typically kind of bad. That's if everything goes down at the same time and all are equally cheap, so there's no opportunity arbitrage. Even if, let's say you own 20 stocks, all of them go down to the same degree that the opportunities aren't changed, because you can't sell something in that case and get a better opportunity for your money in another stock because they're still equally good buys. Or if everything goes up at the same time, because in that case, let's say all of your favorite holdings have gone up so much that the future expected returns on a 2-year period might be 35%. Now let's say actually lower. Let's say 22%. That's like the the best 10 best opportunities you can find are so highly priced that you expect them to maybe have a price to future value gap of just 22%. That's not too much over a 2-year period. But as long as one hasn't gone up, that still offers, let's say, 86%. I mean, that's obviously a better buy than the other 19 where you only have, let's say, 25. So again, the moral of the story is that volatility is what kills people, why everybody thinks this sector is so hard. But when you actually learn to use volatility, that's the single biggest reason why you can actually make a lot of money in this sector. And of course, have a longer time horizon than Mr. Market and a lot of patience. Because I think you actually have to, going from, again, it's like I said in the last video, this was over a 2-year downtrend. So you can judge your long-term results just looking at what your mining portfolio did over this period of time. Give it 2 more years to when we get back to this level again. That's fair. You have to basically compare sentiment levels to sentiment levels. If you are down from this period to here, that probably means you're making a mistake. If you're down from this period to here, that's like totally understandable. I was down 50%. I was down 50% here as well. So that's not a fair assessment, because you can't start buying only in a top of a bull, then look at what your portfolio did down. I mean, preferably you should start off by buying cheap, obviously, and the only remedy to buying high is to buy cheap. I can buy pretty much as many highs as I want to, just as long as I increasingly buy low and cheap. Because then I can afford to buy high. And hopefully you will not only be in a trading sardine like, Bear Creek Mining, which basically goes to the same level all the time. So you actually have to sell out and get back in sometime, and then sell out again and get back in, because it hasn't really created that much value after dilution over the last 12 years or whatever. So you have to do obviously if you combine stock picking and understanding how sentiment works, and you use volatility as your friend, you could absolutely kill this sector. But almost nobody does that. So it's the most ironic thing is like the biggest curse to people is volatility, while volatility is the one thing you actually need to have in a sector to have sometimes absurdly long-term results. Because if you understand how to use the sentiment swings, knowing that what goes down will always I'm talking sector-wide, not a specific company. What goes to extreme lows will always go higher, and what goes to extreme highs will always come down to earth and rinse and repeat. If you just understood that, you could be trading stuff like Bear Creek Mining. Sure, it would take 1-2 years on average before you got a big payoff, but it's okay, what would this payoff be? Let's say you started buying here, bought all the way down, your average is down here. If you're up 70% or wait for an actual top 120% in 2 years or whatever, 3 years, that's obviously very, very good results. The market average is 8 to 9% per year. So even though it doesn't look like much, superb results. Thanks for listening. Assume I'm biased. I own shares of Lion One Metals, but I thought it was a good example, and I know I harp on about this volatility in value trading, but this is probably as good, the best way I can try to, I mean, explain it. That again, it's like price is what you abuse. You abuse Mr. Market's price swings. Not get abused by it, like buying every top when it's like the risk reward is getting worse, and then selling every low as risk reward increases. Should do the complete opposite. And forget about, again, it's like almost every opinion you will hear is like bad, to put it mildly, because I mean, if 95% of people don't really beat the index over the long term, do you think, how many opinions you see out there do you think come from the very few who actually beat an index? Very few. Common sense is not common. It's like, I mean, I hate to see it. It's, again, you see it all the time. People always sell low and buy high. Yeah, anyway, thanks for listening. Do your own due diligence. Investing in miners is obviously risky, so you shouldn't go all in on any particular stock. You can lose all of your money, etc., etc. Thanks.